Welcome to the deep dive. You're here because you want to get the essentials quickly but thoroughly right, and that's what we do.
Exactly. Straight to the core.
Today we're tackling something pretty interesting. The financial engine behind India's renewable energy scene.
Mm-hmm.
We've got the standalone and the consolidated financial statements for IREDA, that's the Indian Renewable Energy Development Agency Limited.
Right, for the year ending March 31st, 2025,
Mm-hmm.
plus the auditor's reports.
And the consolidated one is key because it loops in their new subsidiary, IREDA Global Green Energy Finance, IFSC Ltd.
Which is quite new, set up in Gift City.
So our mission today, pull out the crucial insights on IREDA's finances, how they run things, their compliance, basically the important stuff.
We want to give you that clear picture, maybe some surprising bits too, without getting bogged down in, all the jargon.
Exactly. A solid understanding of this really pivotal player in green energy. Okay, let's dive in. How does IREDA talk to its own oversight bodies?
Well, what's quite telling from a governance angle is how open they seem to be. They actively communicate with their governance folks about the audit itself.
Mm-hmm.
The scope, the timing, any big finding.
Including weaknesses and controls?
Yeah, exactly. Any significant deficiencies in internal financial control, that level of communication, it's generally seen as a good sign.
And it goes beyond just the findings, right? They talk about ethics, too.
Mm-hmm. They make a point of confirming they meet ethical standards, especially around auditor independence.
So they disclose any potential conflicts?
Yes, any relationships that might even look like they could affect independence and what they're doing to safeguard against that. It really seems like building trust is a priority.
Okay, makes sense. Now, what about the money itself? Where do the funds they lend out actually come from?
Right. So if you look at how these institutions work, management has basically stated that the funds IREDA gets don't have specific strings attached.
Meaning?
Meaning they're not told, you must lend this money to person X or entity Y by the people providing the funds.
Ah, okay, so they control their own investment strategy.
It suggests that, yeah, they maintain control over where they think the funds will best support renewable energy projects, rather than just being a pass-through.
Got it. They're not just executing someone else's plan. Okay, moving to loans, investments, guarantees. There was something about certain rules not applying.
Yeah, that was interesting. For this financial year, 2025, IREDA says the reporting rules under Sections 185 and 186 of the Companies Act.
Which deal with?
Loans to directors, related parties, company investments, that kind of thing. They say those sections aren't applicable to them.
Why would that be?
It likely comes down to their specific setup as an NBFC, a non-banking financial company, and their particular regulatory framework. Different institutions, slightly different rules sometimes.
Okay, so parts of standard company law just don't fit IREDA's model. What about taking money directly from the public, like deposits?
The reports are clear on that. IREDA hasn't accepted any public deposits.
So all those RDI rules about deposits
Don't apply. And neither do Sections 73 to 76A of the Companies Act, which also cover public deposits. It fits their classification non-deposit-taking NBFC.
Right. They rely on bonds, loans, other sources.
Exactly.
Okay, now a really critical point for any lender. Default. What's IREDA's track record based on these reports?
It looks good, actually. Very reassuring. They report they haven't defaulted on any of their other borrowings or interest payments to any lender.
No defaults at all.
None reported. And importantly, they haven't been flagged as a willful defaulter by any bank or financial institution either.
That's definitely a strong positive. It suggests responsible management of their own debts.
It does. And it seems their internal records match what they tell lenders too.
How so?
The statements about their book debts, the money owed to them that they file with banks, they're reported to match IREDA's own internal accounting books.
So consistency there.
Yes, adds confidence. Plus, none of their borrowings were guaranteed by directors personally.
Yeah.
And no breaches of loan covenants, those specific conditions attached to loans. It all points towards pretty sound financial management.
Absolutely. Now let's get into something that sounds technical but is super important. Internal financial controls.
Right. And the key thing here is the auditors seem confident in IREDA's system for internal financial control over financial reporting.
They gave it a positive opinion.
Yes. They stated the audit evidence they got was enough to support that opinion.
Okay, for listeners maybe not deep in finance, what does internal financial controls over financial reporting actually mean in simple terms?
Think of it as the company's internal rule book and safety mechanisms.
Okay.
It's a whole process designed to give reasonable assurance that their financial reporting is reliable, accurate, and prepared according to the accounting rules, like NPAs.
So it's about making sure the numbers are trustworthy, checks and balances.
Exactly. Preventing errors, preventing fraud, ensuring the financial statements truly reflect what's going on financially.
What kind of things do these controls cover specifically?
Oh, a whole range. Policies, procedures, things like maintaining accurate records of every transaction, keeping track of assets, making sure transactions are properly authorized by management and directors.
So making sure sales are real, expenses are approved, assets are safe.
Precisely. It's all about ensuring transactions get recorded correctly to prepare the financial statements properly. It builds accountability and robustness into how they manage their finances.
That's very clear. So getting that auditor thumbs up on controls is a big deal for financial integrity. Okay, let's zoom out a bit. Where does IREDA fit in the bigger Indian financial picture?
Well, connecting to the regulatory side, IREDA is classed as a systemically important non-deposit-taking NBFC. NBFC NDSI is the acronym you often see.
Systemically important, okay.
And also NBFC middle layer under the newer regulations. Crucially, they're registered with the RBI as an infrastructure finance company, or IFC.
So the RBI is their main regulator.
Yes, the Reserve Bank of India oversees them, applying specific rules for their role in infrastructure financing.
They're a major player then in that non-bank space. What about public markets? Are they listed?
They are. Both their equity shares, their stock, and their debt securities, like bonds, are listed on the NSE and the BSE.
National Stock Exchange and BSE, LTD.
Okay. That public listing means more scrutiny, more reporting requirements to investors and regulators.
And the actual accounting rules they follow.
They stick to Indian accounting standards, Ind AS. Those are issued by the Ministry of Corporate Affairs. It makes their reporting consistent and comparable with other companies using Ind AS.
Right. Now, something that can get tricky, valuing financial instruments, especially if there's no active market price. How does IREDA handle that?
Yeah, that brings up valuation techniques. When there isn't a direct active market quote for something, management has to use valuation models or techniques.
Educated guesses.
Well, informed estimates, let's say. They involve assumptions about what the market would pay. The aim is to get to a fair value that reflects how knowledgeable participants would price it right now.
Okay, so estimating a realistic value. How do they keep that objective? Is there a process?
Yes, there's a hierarchy they follow. It prioritizes using observable market data whenever possible.
Like different levels.
Exactly. Level 1 is the best, using quoted prices from active markets for identical instruments. If that's not available, they go to Level 2, which uses observable data, maybe for similar instruments or based on market rates, but might need some adjustment.
And if even that's not possible?
Then it's Level 3. That relies on inputs that aren't directly observable in the market. So it involves more of the company's own assumptions and models.
More judgment involved there.
Definitely. This hierarchy, Level 1, 2, 3, ensures some rigor. Level 3 valuations always get closer scrutiny from auditors, understandably. It's like valuing a house. Level 1 is identical recent sales next door. Level 2 is similar houses nearby needing adjustments. Level 3 is a unique historic property needing expert judgment.
That's a great analogy. Okay, let's switch gears to leases. How do they account for leases, both when they're the tenant and when they might be the landlord?
It depends. For short-term leases, 12-month or less, and for leases of what they call low-value assets.
How low value?
Assets worth up to 10 lakh rupees, so $10,000. For those, they just expense the lease payment straight over the lease term. Simple treatment.
Okay, keeps it straightforward for smaller stuff. What if IREDA is the one leasing something out?
Then, as the lessor, they have to classify it. Is it a finance lease or an operating lease?
And the difference is?
It hinges on whether the lease basically transfers most of the risks and rewards of owning the asset to the lessee.
Ah, okay.
If it does, it's a finance lease, treated more like they've sold the asset. If not, it's an operating lease. They keep the asset on their books, and the lease payments they receive just come in as income, usually spread evenly over the lease term.
Got it. Different rules depending on which side of the deal they're on. What about their long-term assets, like buildings or equipment? How do they handle potential drops in value?
That's where impairment comes in. At every reporting date, IREDA has to check if there are any signs that an asset's value might have fallen below what's recorded on their balance sheet, the carrying amount.
Signs like what? Damage? Obsolescence?
Things like that, yes.
Yeah.
Or maybe the asset just isn't generating the cash flows they expected. If there are such indicators, they have to estimate the asset's recoverable amount.
Recoverable amount.
It's the higher of two things: the asset's fair value minus the cost to sell it, or its value in use, which is basically the present value of all the future cash flows they expect to get from using that asset.
Okay. And if the book value is higher than this recoverable amount?
Then they have to write the asset's value down to the recoverable amount and recognize an apparent loss in their profit and loss. So it's about making sure asset values aren't overstated.
Right, keeping the books realistic. What about employee benefits, especially retirement stuff? Those are long-term obligations.
Yes, and any gains or losses that pop up from, let's say, remeasuring these retirement liabilities using updated actuarial assumptions, those get recognized in other comprehensive income, or OCI.
OCI, that's separate from the main profit and loss statement, right?
Correct. It captures certain types of gains and losses that aren't considered part of the regular operating performance for the period.
And how does IREDA actually manage and fund these benefits, like Provident Fund, gratuity?
They typically manage these through separate trusts. They make contributions to these trusts, often based on a percentage of employee salaries. These contributions are then expensed in their profit and loss statement when they're made.
Okay, let's move to something a bit more complex. Derivatives. How are those handled in the accounts?
Derivatives, financial contracts, whose value depends on something else, like an exchange rate or interest rate, they get recognized on the balance sheet at fair value. That's often called mark-to-market, or MTM.
What about the costs of setting up these derivatives?
Transaction costs related to derivatives are expensed immediately. They don't get added to the value of the derivative itself. They hit the profit and loss straight away.
And when does IREDA stop recognizing a financial asset on its books? Like, when does a loan disappear from their balance sheet?
It's de-recognized when one of two things happens. Either their contractual right to get the cash flows from that asset simply expires, or they transfer those rights to someone else, and that transfer meets specific accounting criteria, basically meaning they've given up control and the risks and rewards.
Got it. The reports also mention hedge accounting. What's the gist of that?
Hedge accounting is a special set of rules you can sometimes apply when you use a derivative specifically to offset a particular risk.
Like hedging against currency fluctuations on a foreign loan.
Exactly. Or hedging interest rate risk.
Yeah.
But to use hedge accounting, the relationship between the derivative, the hedge, and the item being hedged has to meet really strict criteria. You need formal documentation of the strategy, and you have to prove the hedge is effective at offsetting the risk. If you meet all the rules, the accounting treatment aims to match the gains or losses on the hedge with the losses or gains on the item being hedged in the same period.
So it gives a clearer picture of the risk management.
That's the idea, yes. Reduces volatility in the reported profit or loss that might otherwise come from just marking the derivative to market.
Okay. Now, let's really dig into the core business. Loans. How does IREDA account for the risk that some loans might go bad?
This is crucial. They use the three-stage impairment model, which is required by NPAs. It's a forward-looking approach.
Forward-looking how?
It means they don't wait for a loan to actually default before recognizing potential losses. They assess how the credit risk of a loan has changed since they first gave it out.
And categorize it into stages based on that risk.
Precisely. Stage 1, Stage 2, and Stage 3.
Can you walk us through those briefly?
Sure. Stage 1 is basically the good book. Loans that have low credit risk or where the risk hasn't significantly increased since day one. For these, they recognize a provision for expected credit losses over the next 12 months.
Okay, 12-month outlook for stage 1. What's stage 2?
Stage 2 is where there has been a significant increase in credit risk since the loan originated. But there's no objective evidence yet that the loan is actually impaired, like missed payments. Think of it as moving to a watch list.
Higher risk, but not definitely bad yet.
Right. And for stage 2 loans, the provision calculation changes. They have to recognize expected credit losses over the entire remaining life of the loan, not just the next 12 months.
So a bigger provision generally for stage 2.
Typically, yes. It reflects the higher lifetime risk.
And stage 3, though the reports focus on 1 and 2.
Stage 3 is when there is objective evidence of impairment. Clear signs the borrower is in trouble and likely to default. For these, they calculate the provision based on the full lifetime expected credit losses, considering the specific circumstances of that loan.
Makes sense. It's a proactive way to account for potential loan losses based on evolving risk. We also keep seeing fair value mentioned everywhere.
Yes, it's fundamental. Many financial instruments, especially derivatives, have to be measured at fair value on each reporting date.
And fair value is?
It's meant to be the price you'd get if you sold the asset, or paid to transfer the liability in a normal, orderly transaction between market participants on that specific date, the market snapshot value.
Okay. Let's zoom into IREDA's standalone numbers now. What does the loan portfolio look like just for IREDA itself?
Standalone statement shows gross loans and net loans that's gross minus the loss provisions.
Yeah.
As of March 31st, 2025, and also March 31st, 2024, interestingly,
Yes.
both gross and net loans were identical at 626.14 crores for both years.
Exactly the same. That's quite stable.
It is. Suggests not much net change in the overall size of their standalone loan book during that specific year.
How are these standalone loans broken down further?
They're subclassified a couple of ways. By the security behind them, like tangible assets, property, equipment, intangible assets, or government guarantees.
Okay.
And also by the type of loan, term loans, loans to staff, loans to key management personnel, KMPs, and also interest that's built up but not paid yet.
And geographically, are these loans mainly in India?
The standalone report splits them. Loans in India, further broken down into public sector borrowers and others. And then it also shows if they have any loans outstanding outside India. Gives a sense of their standalone operational reach.
What about other financial assets IREDA holds besides loans on the standalone basis?
Beyond the main loan book, their standalone other financial assets include things like security deposits they've paid out, cash advances to staff and KMPs, revenue they've earned but haven't billed yet.
Unbilled revenue, right.
Yes, and other miscellaneous financial assets. The report gives the figures for both year ends, so you can see the changes.
There is also a line for subordinated liabilities in the standalone accounts. What are those exactly?
Subordinated liabilities, or subordinated debt, is basically debt that ranks lower than other, more senior debt if the company were to be liquidated.
So the lenders get paid back later.
Potentially, yes.
Yeah.
If things go wrong, senior debt holders get paid first, then subordinated debt holders. It's riskier for the lender, so it usually carries a higher interest rate. The report shows the total amount of this type of debt IREDA had standalone as of March 2025. It's part of their capital structure.
Okay. And provisions. What future costs are they setting money aside for in the standalone financials?
The standalone report lists provisions mainly for employee benefits, things like leave encashment for unused holidays, post-retirement medical costs, sick leave, baggage allowances, even farewell gifts.
Yeah.
They estimate these future costs and book a provision now.
Got it. What about reserves? What kinds of reserves are shown in the standalone equity section?
They show the movements during the year in a few key reserves. There's a special reserve under the Income Tax Act, which has tax benefits attached. There's also a debenture redemption reserve money set aside specifically to repay debentures when they mature, and a gratuity reserve earmarked for employee gratuity payments.
Speaking of gratuity, the standalone report seemed to have specific details on that.
It did. For FY25, it mentioned recognizing about 0.19 crores for half-pay leave based on actuarial valuation. It also outlines their gratuity policy. 15 days salary per year of service, needs 5 years service to vest, and capped at 20 lakhs per person.
And the amount actually on the balance sheet for gratuity.
That's based on an actuarial valuation too, showing the net asset or liability position for the gratuity plan.
They even did a sensitivity analysis for these benefits.
Yes, the standalone report shows how changing the discount rate assumption up or down by 0.5% would affect the calculated present value of obligations for gratuity, medical benefits, leave, baggage, etc. It shows how sensitive these liabilities are to economic assumptions.
Interesting. We also saw notes about changes in directors in the standalone report.
Yes, it mentioned an extension for Sri Amitabh Mohapatra holding the additional charge of Director of Finance until a permanent appointment is made.
Okay.
And also that Sri Chadi Shah was given the additional charge of Director of Projects. Just updates on the current leadership roles.
What about financial dealings between IREDA standalone and its key management personnel, the KMPs?
The standalone report details loans and advances given to KMPs, the balance at the start and end of the year, and any new ones given during the year.
And the terms?
It explicitly states transactions with related parties, including KMPs, are done on an arm's-length basis, meaning fair market terms. And remuneration and loans follow company service rules. It also says no pending financial commitments to related parties exist. Transparency is key there.
Good to know. Let's quickly revisit loan defaults from the standalone perspective. How do they define default, and what collateral do they usually take?
Standalone, they define default based on objective evidence of impairment, basically, signs the borrower won't repay.
Yeah.
For Stage 3 loans, it's a case-by-case assessment.
And collateral?
The main types mentioned are fixed deposit receipts, FDRs or KVPs, a legal charge over immovable property of the promoters, and corporate guarantees from the borrower or related entities. The mix depends on the specific loan.
What about money owed to IREDA by customers' trade receivables standalone? How do they assess the risk there?
The standalone report has an aging analysis of trade receivables as of March 31st, 2025. It breaks down how long receivables have been outstanding, under 30 days, 3160, etc.
And the potential losses.
Alongside the aging, it shows the gross amount and the net amount after deducting the provision for expected credit losses. Helps gauge the credit risk in those receivables.
Liquidity meeting short-term bills is vital. How does IREDA manage that risk standalone?
They have a formal, comprehensive asset liability management framework for liquidity risk. They follow RBI rules on the liquidity coverage ratio, LCR.
LCR.
It requires them to hold enough high-quality liquid assets, HQLA, to cover their estimated net cash outflows during a 30-day stress scenario. They maintain this HQLA buffer as per RBI guidelines.
Good. A formal process. Does the standalone report say anything about their access to more funding if needed?
Yes, it states the total amount of undrawn borrowing facilities available to them at year-end. That's an indicator of their potential borrowing capacity.
We also saw a note about a fresh issue of equity shares in the standalone report. What was that about?
Right, the standalone report highlighted an increase in net proceeds from a fresh equity issue. They raised 1,259.808 crores net.
And the purpose?
Primarily to strengthen their capital base, helps meet capital adequacy requirements, and provide more funds for lending in the renewable energy sector, fueling growth, basically.
How does the standalone report categorize all their financial assets and liabilities based on accounting measurement?
He gives a summary as of March 31st, 2025, grouping them by measurement basis. The main buckets are amortized cost,
Which is usually 4.
loans held to collect payments, most basic debt securities. Then there's fair value through other comprehensive income, FVOCI, maybe certain equity investments or debt, held with an intention to both collect payments and potentially sell. And finally, fair value through profit and loss, FVTPL.
Which includes?
Definitely derivatives, and any assets held primarily for trading. This classification follows the IREDA rules and shows how value changes hit the financial statements.
What about those level 3 derivatives, the ones valued using less observable data? Any more detail standalone?
Yes, the standalone report shows the changes in their level 3 derivatives during the year, gains or losses recognized in P&L or OCI from fair value changes.
And the valuation itself.
Importantly, it says the mark-to-market valuation for their hedging derivatives comes from a registered independent valuer. That adds a layer of credibility to those level 3 values.
The standalone report also mentioned leases under IREDA 116. What's covered there?
It mainly refers to their leases for office space in Delhi and Mumbai, a residential space in Delhi, and land for a solar park in Karnal. Different lease terms, different payments. They apply IREDA 116 measurement rules, except for those short-term or low-value leases where they use the exemptions, consistent with their policy.
What about corporate social responsibility, CSR, on a standalone basis?
The report discloses the amount they were required to spend on CSR by law, how much they actually spent or sanctioned, and whether there was any shortfall or excess compared to the requirement. Shows compliance.
Okay. There was also reference to RBI Master Direction compliance in the standalone report. What's key there?
Two main things. First, they didn't implement any resolution plans during the year, which are for entities in financial stress. Second, and more importantly, it reports their capital to risk-weighted assets ratio, CRAR.
The capital adequacy ratio.
Exactly. It shows the CRAR broken down into Tier 1 and Tier 2 capital for both March 2025 and 2024. This is a key regulatory metric. It also noted a change in the risk weight applied to commissioned renewable energy project assets.
Which would affect the CRR calculation.
Yes, a lower risk weight generally boosts the CRR, suggesting a stronger capital position relative to the riskiness of those assets.
There were also quantitative disclosures on derivatives standalone.
Right. That section gives specifics. The notional principal amount of their outstanding contracts shows the scale. Their mark-to-market position the current value as assets or liabilities. And any unhedged exposures. Gives a snapshot of their derivative activity and risk.
Credit ratings are important. What ratings does IREDA have standalone?
The report lists ratings from both domestic and international agencies for their long-term and short-term borrowings. Includes issuer ratings, ratings on bank loans, and even on their perpetual debt instruments. reflects the agency's view of their creditworthiness.
What about the provisions for bad loans, NPAs, standalone? How did those change?
The standalone report shows the movement, opening balance of provisions, new provisions added during the year, any amounts written off, or any excess provisions written back to income. Tracked how their estimated losses on NPAs evolved.
Given they're a lender, what about funding concentration standalone? Are they reliant on a few sources?
The report addresses funding concentration by identifying their significant counterparties, the major sources they get funding from, other than public deposits, which they don't take. Helps assess risks related to funding sources.
How is the overall balancing act between assets and liabilities managed standalone?
The board has set up committees for this. An Asset Liability Management Committee, ALCO, specifically manages the asset liability match. There's also a risk management committee for broader risks and an investment committee. They work together on the profile, risk, liquidity, funding, and capital planning.
We also saw some cash flow details standalone linked to liquidity management.
Yes, a summary of key inflows and outflows relevant to liquidity risk. Things like unsecured and secured wholesale funding received, potential extra collateral needed for derivatives, and potential outflows if funding lines were cut. It also reports the total value of their high-quality liquid assets, HQLA, and their liquidity coverage ratio, LCR, key liquidity metrics.
Lastly, for standalone, there was that comparison of provisions under different rules.
That's right. It compares the provisions needed for NPAs under the RBI's prudential norms, IRC norms, versus the impairment allowance calculated under the accounting standard, IND AS 109. Highlights any differences between the regulatory view and the accounting view of potential losses.
Okay, wow, that was a deep dive into the standalone picture. Let's shift now to the consolidated statements, the whole group, including the new subsidiary. First thing that jumps out is an emphasis of matter from the auditors. What's that highlighting?
This is really important. The auditors are drawing attention to specific loans, totaling a hefty euro 152.21 crores.
Okay.
IREDA, the parent, has classified these loans as Stage 2 standard in the consolidated accounts. Why? Because of an interim order from the High Court of Andhra Pradesh. But under the standard RBI prudential norms, these same loans would be classified as Stage 3 non-performing assets, NPAs.
So a direct conflict between a court order and RBI rules on classification?
Exactly. And the auditors aren't disputing the accounting based on the court order, but they want users to be very aware of this specific situation and the divergence from the usual regulatory classification. The required disclosures explaining this are in the notes.
That's a huge difference, standard versus MPA. How are they handling the interest income on these specific loans then?
Prudently, it seems. Even though the court order allows Stage 2 classification, IREDA is recognizing interest income on these loans only when they actually collect the cash.
Not on an accrual basis.
No, on a cash basis for these specific loans. It reflects caution given the underlying situation that would normally classify them as NPAs under RBI rules. And they've still made an allowance for impairment loss on them, acknowledging the risk.
Okay, that makes sense. The auditors also identified some key audit matters in the consolidated report areas needing special focus. What were they?
A few key things. Revenue recognition was one, especially with the complexities of IND AS 115 and just the sheer volume of IREDA's transactions.
Right. What else?
Evaluating management's internal controls over derivatives, how they classify them, value them, the models they use. Derivatives are complex, so that's a natural focus area.
Makes sense. Anything else on derivatives?
Yes. Specifically verifying the mark-to-market valuation reports for all the outstanding derivative deals at year-end, directly linked to the valuation concern.
Okay, so revenue and derivatives were big ones. Was there anything else flagged as a key audit matter?
Yes, one more significant one. The ongoing demands from various tax authorities.
Why was that key?
Because of the uncertainty around the final outcome and the potential for these demands, if upheld, to have a substantial financial impact on the consolidated group. It's a potential future hit the auditors felt was important enough to highlight.
Unresolved tax issues, always a potential risk. The report also mentions other information, what's usually in that part of an annual report.
Other information typically includes things like the director's report, management discussion, and analysis, the narrative sections. It specifically excludes the financial statements themselves and the auditor's report on them.
And who's responsible for that other information?
The responsibility lies with IREDA's board of directors.
Yeah.
The auditors usually state they don't provide assurance on it, and in this case, they noted it was expected to be available after their report date.
And who is ultimately on the hook for the consolidated financial statements themselves, making sure they're true and fair?
That responsibility rests squarely with the board of directors of the holding company, IREDA Ltd. They have to ensure the consolidated statements give a true and fair view according to Indian accounting principles, including NPAs.
We know IREDA has this new subsidiary now. Can you give us a bit more on IREDA Global Green Energy Finance, IFSC Ltd. IGFIL?
Sure, IGFIL is wholly owned, set up in the IFSC in Gift City, incorporated May 7, 2024. It got its registration as a finance company from the IFSC Authority in February 2025, so quite recent.
Operates under IFSC rules, then.
Exactly.
So the consolidated financials combine IREDA and IGFIL. What's the main business of this combined group?
The group collectively is focused on promoting, developing, and financing projects in renewable energy, energy efficiency, and conservation. It's IREDA's core mission, now potentially expanded through the IFSC platform.
And the basis for preparing these consolidated statements?
They're prepared, assuming the group as a going concern will continue operating. They use the accrual basis of accounting, recognizing income and expenses when earned or incurred, not just when cash moves.
Based on historical cost, mostly.
Generally, yes, the historical cost convention, though some items are measured differently as per their policies. And they follow the specific format for NBFCs under the Companies Act, Division 3 of Schedule 3, and NAS 7 for the cash flow statement.
The report summarizes key accounting policies, too. We can't go through all of them, but which ones are particularly important for understanding the IREDA Group's financials?
Several stand out.
Yeah.
Policies on property, plant and equipment, PPE, and intangible assets are key for their long-term assets. Leases, how they handle right-of-use assets and lease liabilities. Impairment of non-financial assets, foreign currency translation, especially now with the IFSC subsidiary, taxation, employee benefits are always significant.
And related to their core business.
Definitely financial instruments and derivatives. Impairment of financial assets, that three-stage loan loss model. And crucially, revenue recognition, covering income from their solar plant, fees, commissions, government schemes, and finally, how they account for expenses.
Got it. Let's look at some specific consolidated numbers. What about trade receivables for the whole group?
The consolidated report breaks down what customers owe the group. It separates undisputed amounts from disputed ones and ages them how long overdue they are. This aging is also linked to credit risk assessment, giving a group-wide view of collectability compared to last year.
Does the consolidated report give any clues about ongoing projects, timelines?
Yes, it provides expected completion timelines for projects that were still in progress as of March 2025 and March 2024. Gives a hint about future activity and potential revenue.
What about intangible assets, like software for the group?
The consolidated report shows the gross value, additions during the year, and balance for intangibles, mainly software, as of March 2024. It also shows the net carrying amount after amortization impairment for both March 2024 and March 2025.
Any other significant non-financial assets held by the group?
Yes. The consolidated report lists things like GOI, fully serviced bonds, money receivable, other receivables, and other advances for both year ends. These are assets not directly tied to lending or financial instruments.
Flipping to liabilities, what about payables for the group? Who do they owe money to?
The consolidated report details trade payables money owed to suppliers. It specifically flags dues to micro and small enterprises as required. And like receivables, it gives an aging analysis for payables for both years. Shows payment patterns.
Debt securities bonds are a big funding source. What types does the group have outstanding?
The consolidated report lists various taxable and tax-free bonds IREDA has issued. For each, it gives the interest rate, maturity date, and amount outstanding at both year ends, noting any transaction costs deducted.
Besides bonds, what other borrowings does the group have?
Other borrowings are mainly term loans from various banks and financial institutions. The report mentions a significant one from the European Investment Bank. Details like interest rates, repayment terms, and any security provided, like charges on assets or government guarantees, are included.
Subordinated liabilities, we saw those standalone. How about consolidated?
They're reported consolidated too. The total amount of this lower priority debt for the group as of March 2025 and 2024 is shown separately. Gives the group level picture of this part of their capital structure.
What about provisions for the group? What future liabilities are covered?
Consolidated provisions cover employee benefits, like standalone. But the consolidated report also includes provisions for indirect taxes and other guarantee commissions, reflecting the broader scope of the group's potential obligations.
Deferred taxes can be complex. Is there a reconciliation in the consolidated report?
Yes, there is. It shows the deferred tax assets and liabilities at the start of the year, the movements recognized in P&L or OCI during the year, and the closing balance. Helps understand the future tax impact of current operations for the group.
There was also mention of decommissioning liabilities consolidated. What's that about?
That most likely relates to their solar power plant. When you build something like that, you eventually have to dismantle it. The report says changes in the estimated cost of this future decommissioning or restoration get added to, or deducted from, the asset's cost, and then depreciated over the asset's remaining life. Spreads the cost out.
Actuarial assumptions for employee benefits, are those detailed consolidated too?
Yes, the consolidated report lists the key assumptions used for valuing gratuity and post-retirement medical benefits for the funded plans. Specifically, the discount rate and salary increase rate used for FY25 and FY24, crucial inputs for those long-term liabilities.
It looked like IREDA received some grants for capital assets. What are the consolidated details?
The consolidated report mentions a grant from the World Bank's Clean Technology Fund, CTF, related to intangible assets. It's treated as deferred income on the balance sheet and recognized gradually in the P&L over the asset's life, effectively offsetting the amortization expense. The report shows the grant balance movement during the year.
Related party disclosures are always important for transparency. What's disclosed consolidated?
A fair bit. It lists the directors and KMPs of both IREDA and the subsidiary and their terms. Crucially, it discloses transactions with the government and government entities, loan repayments, interest, guarantee fees, raising bonds for M&RE. Given their PSU nature, these are significant. Balances and transaction amounts for both years are provided.
So lots of government interaction. Any other related party stuff disclosed?
Yes, interest received and principal repaid on loans to government-related entities. Also, service charges earned for running government schemes. And like standalone, details of loans and advances to the group's KMPs are disclosed too, all about transparency.
The report mentions separate financial statements under IND AS 27. What was that reference for?
It's just confirming the existence and purpose of the subsidiary, IET-FIL. Highlighting it was set up specifically to provide foreign currency debt for renewable energy from the IFSC. Clarifies the structure.
And there's a list of subsidiaries to make that structure clear.
Yes, the consolidated report confirms IG-FIL's is only subsidiary and IEDA holds 100% ownership. Defines the consolidation scope.
Okay, let's look at some group performance metrics. Earnings per share, EPS.
The consolidated report calculates basic EPS for FY25 and FY24. It uses net profit attributable to equity holders and the weighted average number of shares. The basic EPS for the group rose from 5.16 in FY24 to 6.32 in FY25.
An improvement in per-share profitability, then.
Yes, based on those numbers.
There was also a review of their expected credit loss, ECL methodology, mentioned consolidated. What changed?
Yes, during a review, they found the depreciation rate they were using for plant and machinery within the ECL calculation was quite high, 40%, higher than industry norms or company law rates.
So they changed it.
Yes, they reduced it to 20% effective from April 1st, 2024. This change actually decreased the impairment recognized on financial instruments by about 77.34 crores in FY25. Shows how assumptions impact the bottom line.
What about foreign currency risk for the group, especially with the IFSC subsidiary dealing in foreign currency?
The consolidated report details their outstanding derivative liabilities, mostly foreign exchange swaps used for hedging. It discloses their overall exposure to risk from USD, Euro, and JPY, looking at assets and liabilities in those currencies.
And the hedges themselves.
It gives details of the derivative contracts used to hedge both currency and interest rate risks, the notional amounts involved, and their fair values at year-end.
Debt-to-equity ratio, a key leverage measure. What was that for the group?
Consolidated debt-equity ratio was 6.31 as of March 31st, 2025. That's up from 5.80 the previous year.
So leverage increased during the year.
Yes, indicates a higher reliance on debt relative to equity for the group over that period.
Plans for another fresh equity issue were mentioned consolidated too.
Yes, it confirms approvals from DPAM and the board to raise more equity via a qualified institutional placement, QIP, up to 7% dilution. Shareholder approval was also obtained.
And the proceeds?
Gross proceeds were 1,290.13 crores. The stated use, again, is to boost the capital base for future growth and more lending for renewable energy projects.
It seems they also prepaid a credit line with an international lender, KfW. What was the financial fallout of that consolidated?
Yes, they prepaid EUR 50 million owed to KfW. Since the loan was hedged, Prepaying meant unwinding the hedges too.
Resulting in?
Unwinding the hedges actually resulted in a net gain of 7.82 crores. However, when you factor in everything, including transferring accumulated foreign exchange differences from reserves to P&L, the overall impact of the prepayment was a net loss of 45.41 crores for FY25.
Wow, so closing it early ended up costing them overall.
It appears so, due to the accounting for the exchange rate movements locked in the reserves, shows the complexity.
How does IREDA report its different business lines or segments consolidated?
They identify two main segments based on how management views the business: financing activities in renewable energy and energy efficiency, and power generation from their solar plant.
But are both reported separately?
For financial recording purposes, the power generation segment is too small to be a reportable segment on its own, so most activity falls under financing. Geographically, they operate mainly in India, so it's considered a single domestic segment. The report does show interest income, fee income, and power sales for these segments, though.
Fair value measurement. Again, how are instruments measured at fair value presented consolidated?
Similar to standalone, the consolidated report categorizes financial instruments by measurement: amortized cost, FVOCI, and FVTPL as of March 2025. It explains the level 1, 2, 3 fair value hierarchy.
And shows the breakdown.
Yes, it breaks down the assets and liabilities measured at fair value based on that hierarchy. And again, it mentions the mark-to-market calculation relies on valuations from a registered independent valuer. Adds that external validation.
Does the consolidated report mention specific funds IREDA receives for government schemes?
Yes, it lists the balances of funds received under various government and other schemes at both year ends. It notes these are kept in separate bank accounts, and the obligation to use them is shown as a liability.
What about interest subsidies they handle?
The consolidated report gives program-wise details of outstanding interest subsidies received earlier. These are typically passed on to borrowers periodically if they meet the loan conditions.
Did the group exceed any regulatory limits on exposure to single borrowers?
The consolidated report explicitly confirmed that as of March 31st, 2024, there were no single exposures exceeding the limits based on their Tier I capital. It uses the 34 and 2023 capital for that check. While not explicitly stated for 2025 in the snippet, the prior year confirmation suggests ongoing compliance.
The consolidated report also lists their registration details with regulators.
Yes, key details of the Ministry of Corporate Affairs for both entities, RBI registration for IREDA Ltd, and the legal entity identifier, LEI, codes for both. Standard regulatory info.
What about customer complaints for the group? Any summary?
Yes, the consolidated report summarizes complaints received from customers and the Banking Ombudsman's Office. Shows pending, received, disposed, rejected, resolved numbers for the year. Also breaks down Ombudsman complaints by status. Gives a sense of service issues, if any.
What about lending concentration? Exposure to the biggest borrowers consolidated.
The report discloses the total exposure to their 20 largest borrowers' customers. It also shows this exposure as a percentage of the group's total exposure. Helps assess diversification or concentration risk in their lending book.
And concentration on the funding side consolidated. Reliance on big lenders.
Similarly, it shows the number of significant counterparties providing funding and what percentage of total liabilities they account for as of both year ends. A significant counterparty likely accounts for over 10% in aggregate. Shows reliance on key funding sources.
We see that comparison of provisioning again, consolidated. Any difference from standalone?
It's the same principle. Comparing asset classification and provisions under RBI norms versus IND AS 109 impairment allowance, but now for the entire group's assets. Helps reconcile the regulatory versus accounting view of potential credit losses group-wide.
Was there any significant buying or selling of loan portfolios by the group during the year?
The consolidated report confirms no reportable cases of loans transferred or acquired during FY25 that would require specific disclosure under RBI directions on loan transfers.
Finally, what about loans to directors, senior officers, or their relatives within the group?
The consolidated report discloses the amounts outstanding for loans and advances to directors and their relatives, and senior officers and their relatives, for both FY25 and the prior year. Standard transparency disclosure for insider dealings.
Well, that really has been an incredibly detailed look, hasn't it? Both standalone and consolidated for IREDA.
It really paints a picture. A complex organization, regulated environment, focused on renewables, but juggling all these financial reporting and risk aspects.
And that emphasis of matter from the auditors on the loan classification.
That's a critical point, definitely. That divergence between the court order and RBI norms is something anyone analyzing them needs to keep in mind when looking at asset quality.
Yeah. For me, some of the really interesting bits were The capital raising, that fresh equity issue,
Yeah.
and the whole story with the KfW loan prepayment.
Right, the unexpected loss from unwinding the hedges. Shows how interconnected things can be.
It really gives a glimpse into their strategic financial thinking, or maybe the complexities they face.
Absolutely. And hopefully, as we aimed for, this deep dive gives our listeners that shortcut, that core understanding of IREDA's financials without having to wade through hundreds of pages themselves.
Exactly. So for you listening, we hope this has been valuable for understanding this key player in India's green energy finance world. Think about what IREDA's financial position and activities might mean for the future of sustainable development in India. The full reports are out there if you want even more detail.
Which leads us to a final thought to leave you with. Given IREDA's crucial role, their financial standing, and now this new subsidiary venturing into foreign currency financing, how might their next moves, their future performance, actually shape the speed and direction of India's whole energy transition?
That's definitely something worth watching.